Investing in stocks just means buying tiny shares of ownership in a public company.
Those small shares are known as the company's stock. And by investing in it, you're hoping the company grows and performs well over time. If that happens, your shares may become more valuable. And other investors may be willing to buy them from you for more than you paid for them. That means you could earn a profit if you decide to sell them. One of the best ways for beginners to get started investing in the stock market is to put money in an online investment account, which can then be used to invest in shares of stock or stock mutual funds. With many brokerage accounts, you can start investing for the price of a single share. There are several ways to approach stock investing. Choose the option below that best represents how you want to invest, and how hands-on you'd like to be in picking and choosing the stocks you invest in. I'd like to choose stocks and stock funds on my own.
Keep reading.
This article breaks down things hands-on investors need to know, including how to choose the right account for your needs and how to compare stock investments. I'd like an expert to manage the process for me. You may be a good candidate for a robo-advisor, a service that offers low-cost investment management. Virtually all of the major brokerage firms and many independent advisors offer these services, which invest your money for you based on your specific goals. I'd like to start investing in my employer's 401k. This is one of the most common ways for beginners to start investing. In many ways, it teaches new investors some of the most proven investing methods. Making small contributions on a regular basis. Focusing on the long term and taking a hands-off approach. Most 401k offer a limited selection of stock mutual funds, but not access to individual stocks. Generally speaking, to invest in stocks, you need an investment account. For the hands-on types, this usually means a brokerage account. For those who would like a little help, opening an account through a robo-advisor is a sensible option. We break down both processes below. An important point. Both brokers and robo-advisors allow you to open an account with very little money. An online brokerage account likely offers your quickest and least expensive path to buying stocks, funds, and a variety of other investments. With a broker, you can open an individual retirement account, also known as an IRA. Or you can open a taxable brokerage account if you're already saving adequately for retirement in an employer 401k or other plan. We have a guide to opening a brokerage account if you need a deep dive. You'll want to evaluate brokers based on factors like costs, trading commissions, account fees, investment selection. Look for a good selection of commission-free ETFs if you favor funds, and investor research and tools. A robo-advisor offers the benefits of stock investing, but doesn't require its owner to do the legwork required to pick individual investments. Robo-advisor services provide complete investment management. These companies will ask you about your investing goals during the onboarding process and then build you a portfolio designed to achieve those aims. This may sound expensive, but the management fees here are generally a fraction of the cost of what a human investment
manager would charge.
Most robo-advisors charge around 0.25% of your account balance. And yes, you can also get an IRA at a robo-advisor if you wish. As a bonus,
if you open an account at a robo-advisor, you probably needn't read further in this article.
The rest is just for those DIY types going the DIY route. Don't worry. Stock investing doesn't have to be complicated. For most people, stock market investing means choosing among these two investment types.
Stock mutual funds are exchange-traded funds.
Mutual funds let you purchase small pieces of many different stocks in a single transaction. Index funds and ETFs are a kind of mutual fund that track an index. For example, a Standard & Poor's 500 fund replicates that index by buying the stock of the companies in it. When you invest in a fund, you also own small pieces of each of those companies. You can put several funds together to build a diversified portfolio. Note that stock mutual funds are also sometimes called equity mutual funds.
Individual stocks.
If you're after a specific company, you can buy a single share or a few shares as a way to dip your toe into the stock trading waters. Building a diversified portfolio out of many individual stocks is possible, but it takes a significant investment. The upside of stock mutual funds is that they are inherently diversified, which lessens your risk. For the vast majority of investors, particularly those who are investing their retirement savings, a portfolio made up of mostly mutual funds is the clear choice. But mutual funds are unlikely to rise in meteoric fashion as some individual stocks might. The upside of individual stocks is that a wise pick can pay off handsomely. But the odds that any individual stock will make you rich are exceedingly slim. How much money do I need to start investing in stocks? The amount of money you need to buy an individual stock depends on how expensive the shares are. Opening parenthesis. Share prices can range from just a few dollars to a few $1,000s. Closing parenthesis. If you want mutual funds and have a small budget, an exchange-traded fund,
ETF,
may be your best bet. Mutual funds often have minimums of $1,000 or more. But ETFs trade like a stock, which means you purchase them for a share price. In some cases, less than $100. How much money should I invest in stocks? If you're investing through funds, have we mentioned this is the preference of most financial advisors? You can allocate a fairly large portion of your portfolio towards stock funds, especially if you have a long time horizon. A 30-year-old investing for retirement might have 80% of his or her portfolio in stock funds.
The rest would be in bond funds.
Individual stocks are another story. A general rule of thumb is to keep these to a small portion of your investment portfolio. Stock market investments have proven to be one of the best ways to grow long-term wealth. Over several decades, the average stock market return is about 10% per year. However, remember that's just an average across the entire market. Some years will be up, some down, and individual stocks will vary in their returns. For example,
concerns about inflation,
the pandemic, and rising interest rates worried some investors and set the markets tumbling in early 2022. But if you're properly diversified and in it for the long term, a good rule of thumb is to just ride it out. For long-term investors,
the stock market is a good investment no matter what's happening day to day or year to year.
It's that long-term average they're looking for. Stock investing is filled with intricate strategies and approaches. Yet some of the most successful investors have done little more than stick with stock market basics. That generally means using funds for the bulk of your portfolio. Warren Buffett has famously said a low-cost S&P 500 index fund is the best investment most
Americans can make.
And choosing individual stocks only if you believe in the company's potential for long-term growth. The best thing to do after you start investing in stocks or mutual funds may be the hardest. Don't look at them. Unless you're trying to beat the odds and succeed at day trading. It's good to avoid the habit of compulsively checking how your stocks are doing several times a day, every day.